You're 79 years old, you're married and retired. You've accumulated $1.1 million in your 401k, and you're asking yourself the question, with everything that's going on, should I convert some of this money to a Roth? Thank you for joining us. That's what we're going to cover in our time today. My name is John Vandergriff. I'm one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people effectively transition into retirement, or if you're like this couple and already retired, we help you plan for some of the things that often get overlooked or missed, and making sure that you have a well-rounded and holistic situation. So as we look at that conversation would not be complete with a look on taxes and tax planning, which is where we're going to be focusing today. And so a couple of things before we get into kind of the meat of our conversation. If you like what you see, like this video, share it with other people, subscribe to our channel, and comment below on any questions or things, observations. We love feedback. We want to help as many people with this stuff as we can. So we appreciate that ahead of time. But then also, what I always say is kind of a disclaimer: don't act on anything that we see here today, because we are looking at very particular situations. You need to make sure that you have all the facts of your situation at your disposal. I would always recommend talking to someone who does tax planning before you make some of these decisions. Again, just so that you have all the information that you need. So, as we said, 79-year-old couple, retired, 1.1 million in 401ks. The question becomes, should they convert to a Roth? Well, again, we're going to look at several factors here. One of which being, obviously, the putting together the plan, seeing all the things that we need to factor into this, because a good, well-rounded retirement plan should cover income needs, investments, taxes, healthcare, and family legacy. So again, all these things have a lot of overlap, which is why they need to be working and fitting together. So as we look at this particular situation, we've got a married couple, age 79 and 77. Combined, their income from Social Security is $6,200 a month. As they are sitting today with the money that they have in 401ks, they are taking out a little over $51,000 of RMDs. We're going to talk about the impact of that. That's based on the level that they're at, but also that we had this spouse at $600,000, this one at $500,000. That's where the calculations came to. And then we've got $200,000 in non-qualified or after-tax money. And this couple needs, roughly $7,000 a month. So Social Security almost takes care of all of it. So really they're pocketing this RMD money that they're forced to take out. So that will probably lend their bank balances to increasing over time. So as we look at this, we've got to see with this particular situation kind of where we're at. So again, $84,000 of need between Social Security. They've got, basically $75,000 or really $74,000 of that taken care of. So they only need about $10,000 here, as you see, $9,600. RMDs are noticeably higher than that. And so the impact of the RMDs and the taxable amount of their Social Security causes their annual income tax rate or income amount to be $114,000, which puts them in the 12% tax bracket. And then as we look at it, they've got $1.1 million in pre-tax money, $200,000 in after-tax, no money in tax-free accounts today like Roth IRAs, properly structured life insurance plans. So the goal, even with this couple at an older age, is to see if it makes sense to start moving this money from pre-tax buckets into tax-free first choice, after-tax second. Is now the right time to do that. Now, one thing that we have to cover, because some people think once they get to RMD age, they can't do Roth conversions. You can, you just have to satisfy your RMD first, which is why we went ahead and took care of that on the situation we just looked at. So again, we'll withdraw the full RMD. You could use some of that RMD to pay the taxes on the Roth conversion, but that RMD balance has to be taken care of first. And unfortunately, the RMD amount is not eligible to go into the Roth. That would make a lot of sense, but I guess the government standpoint is, since they're making you take that money out, it's not Roth eligible. I don't make the rules. I just am the messenger here. So as we look at it, anytime we have this movement of monies from a 401k to a Roth position conversation, we want to examine whether that's a good idea or not. Because again, it's not a holistic recommendation for every person today, especially if you were going to have a noticeable drop in income or your situation would change a lot from a tax perspective. So what we're going to look at is an example here that I use just about every day when we talk to people to help them understand what we're really focusing on in this conversation. So what we're going to look at is $100,000 stays in the 401k versus if that money comes out and moves into a special kind of retirement account called a Roth IRA. Like we said, the benefits of this is once this money is established, the account's in place for 5 years, we have now tax-free growth on and tax-free withdrawal off of this money in perpetuity. So as we look at this, we've got to examine this because even though tax-free sounds amazing, it may not be the best situation depending on what you have. So if we leave the 401k alone, obviously no tax impact because these are tax-deferred dollars. Again, for this couple, they're forced to take RMDs, so we're considering this money as, after the RMDs are taken care of. The Roth account, we've got a 20% tax hit, let's say for round number sake. So if they move that money out, they now start that account with $80,000 if they pay the taxes out of this bucket. Some people will stop at this point and say, why is this a good decision? Financial advisors will contact me and tell me this doesn't make sense for clients because, again, this is all they're focused on. But again, we've got to look at the rest of the projection here because this is taxable money, this is tax-free. So we're not looking at the same two buckets of money. So in the 401k, let's assume that we invest this money the same in both scenarios. So again, it doubles at the same time. This helps us take care of time value money, inflation, whatever things people want to throw into this conversation that don't really matter to the actual tax conversation here. And so what we know from the Roth being in place for at least 5 years that this conversion of $100,000 that's now $160 is fully tax-free to take out as much or as little as you want to. The 401k, though, has never settled up with its taxes, so it depends on the tax environment at the time you take distributions. Now, what's interesting is if this 20% tax bracket is the same as it was at the beginning, notice the math here, you are sitting at $160,000 of money in both buckets. So if the tax brackets stay the same, the bottom line is the same, okay? I don't think that's very likely for most of the people that we talk to, that taxes won't change for them. But again, I'm not able to predict the future. Now, when we talk about taxes in retirement accounts or your savings, most people think, oh, well, taxes aren't going to go up in retirement. They're actually going to go down because my income will go down. Therefore, I will show lower taxes. That could be true for some of you that watch this. I think that's rather unlikely. But if that did happen, 10% bracket, you would notice that in this scenario here, you would not have 160. You would actually have more money in the 401k by leaving it alone and less money in the Roth, even though it grew tax-free. So as we look at this, again, that's the way that a lot of retirement advice has been based for years. The problem with that today is we are in a noticeably different situation with the amount of debt and overspending that's happening in Washington. We're at a place where we've got $31 trillion of debt that we owe. We have a debt to GDP ratio of over 120%, which is insane. And we're overspending our budget by a pretty wide margin on an annual basis and not showing any signs of slowing down. So all those things lend me to believe that I think taxes will go up for most of the people we're talking to. And if that is the case, that directly hits this money in the 401k because that money is 100% exposed to what happens with income tax rates. So as we look at this, this is why we're looking at this discussion for so many people, regardless of age. It's not an age discussion. It is when can we pay the lowest percentage tax? If it's now, let's look and see what makes sense. If not, let's not make a decision there. So as we look at it, for this particular couple, what we notice is that they've got $114,000 and change of taxable income, so they slide barely under the 12% bracket when you factor in standard deductions for a married couple here. If we compare that to 2017's brackets, which some people say, why are you using 2017? Well, that's really what is in place to happen if nothing changes. The tax code that we exist in today will expire after the 2025 tax year, revert back to these brackets if there are no extensions of the current code or also if the government doesn't change taxes before then. That's something that we've got to factor in. So if it did go back to 2017, we've adjusted these numbers for inflation, you will see that their income goes into the top, or 12%, and instead of 12, goes into the 25% bracket, because they jump a little bit above that 111,000. And then the last one here, 1981, you will notice that this is a time where taxes were significantly higher than what we've had today. Now, not necessarily in these brackets, but as you start to progress through here, you notice the top bracket there of 70% is noticeably higher than 39.6 based on 2026 rules, or 2023's 37%. So when we look back at history, we've had several years where we had taxes over 70%. The more income you gather, the more noticeable this tax event is. And so as we look at it, this couple slides in the top dollar at 28% in this particular situation. So as we look at the numbers now, if they started conversions, their top dollar would be at 12% today. We compare that to 2017 or 2026, however you want to talk about that, that would be 25%. And 1981 would be more than double, just like here at 28%. So again, if this couple stayed married, they stayed in these same tax brackets, we're showing a time where they would have a lower tax position today, which is something to consider when it comes to these conversions. Now, I've had a lot of feedback from people when I watch these videos. They say, well, what happens, especially in this scenario, with an older couple if that spouse dies? Well, when we have that happen, we need to know that there's a lot of things that take place and change in your situation, not just how much you spend, but also maybe what is coming in the door, but definitely your tax brackets. So when we look at this, at the death of a spouse, that year that death occurs may be the last tax year that you have to file as a married filing jointly person. The years after that, unless you get remarried, are going to be single filers. So the brackets are going to be drastically different there. You may also have income changes with Social Security. If you're both taking, the bigger check will stay, the smaller check will drop off. But as we look at this, the big kicker here is one spouse will inherit the IRAs from the other one as if it's theirs. It's not an inherited IRA, it's just their IRA as the spouse, and they will still owe the full balance of RMDs based on their age. So as we look at that, that starts to change this picture a little bit, because when we look, and what we did here is instead of the $84,000 of income need, we said, well, not half, but let's say that this spouse that's surviving needs 2/3 the amount of income that they had before, again, because not everything cuts in half. The higher Social Security check stays, gives them $42,000 of income, so they need 18 from their savings, but RMDs are forcing them to take, or this surviving spouse, $50,000 out. So that jumps their taxable income to $85,700, puts this single person now from the 12% bracket to now the 22% bracket, which is almost double. And as we're looking at this, let's say that happened the following year, they hadn't done any conversions here, they've got a noticeable bucket here, and however many years they have left of potentially higher taxes. Because as we look at the way things are in 2023, again, 22 bracket goes up to $109,000 for them at roughly $85,000 of income here. The 2017, which would become 2026 if no changes, would be at 25% for this couple. So again, more than double the 12% bracket that they are in currently while both spouses are living. But then look here with single filer here, $85,000. They're pushing the top of the 30% bracket. Won't take too many more years of RMDs to push them into the 34%. But jumping from 12 as it is today for this couple that survive, or this spouse that survives, to go to potentially 30, that's almost tripling their tax position. So as we look at this, if the single spouse or surviving spouse, that death event occurs today, 22% is their new tax bracket moving forward. The distribution from 2017-2026 will be 25. As we said, 30% if things got as bad as they were in 1981. I think reality may be somewhere between these numbers, but that's a noticeable jump. And so we've got to factor that into the conversion conversations that we're having today. So question becomes, how much to convert? As we said, Based on things today, $114,000 is the taxable income, so they've got a little less than $3,000 that can be converted at 12%. I think that makes total sense. If you wanted to maximize the brackets today that are under both of those starting points in the future, 22 and 24% conversion would push them into income levels over $390,000. And then as we look here, $277,000 of amount actually converted. And when we factor the taxes in here, 23% is the effective tax rate. Now, we always like to factor this into it as well when it comes to the cost and impact to Medicare. And so again, this would be kind of a caveat here, depending on the situation. If no death occurs, we've got a income situation here that would probably cause this couple to jump and add another $10,000 of cost to this conversion, which would put them at an approximate conversion cost of around 25%. If a death occurred, this would allow the spouse to redirect this conversation, and obviously it would only affect one income there, or one Medicare, which would be roughly half this. So you may be just under 25% on your total cost of conversion there. Depending on when a spouse passes, if they don't, it will be a more impact. If they do, then it will be less impact to the overall situation. So as we look at this, we've got to factor in, when we look at this particular conversation, obviously what things are today, but the aging population here, we know we're not going to live forever, so we've got to factor in, for that surviving spouse, what will the picture look like when we have this conversation. So if somebody's not ever talked about this, losing a spouse is a reality. The things that will change is a reality. We've just got to make sure that we factor all of these things into this conversation of tax planning for the decisions that we can make today. And if you've not had that conversation, we would love to share whatever we can with you to help you make good decisions today. And again, obviously, if you would like our assistance with those things, we'd be more than happy to provide that. So you're going to see a link here below where you've got our calendars that you can pull up, schedule a time where you can talk to us either on the phone or virtually or in person if you're here close to Tennessee. But yeah, I mean, as we look at this, we've got a lot of things to consider with these type of movements. And so we want you to be as knowledgeable and keep as much of your money as possible. So thank you for joining us today. Hopefully you like this content. As we said, make sure you like, subscribe to our page, share this with other people so that we can get the word out and help as many people make good decisions when it comes to taxes as possible. So that's all we have for you today. We look forward to sharing another video with you next week. But that's all we have for now. Hopefully you enjoyed this and learned something today.